And what is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be talking about my four stock picks for the month of November 2025. These are all stocks that I've been buying now for a while. And the first one on my list is going to be a company called Shift4 Payments. This company is a payment processing company. They pretty much specialize in working with stadiums and hotels and bigger locations where there might be lots of different points of sale around the location, right? And so it kind of integrates all that into one software where it can easily be managed. So there are a lot of payment processing companies out there, and it's not like they have, some giant moat or there's that big of a difference. They're pretty similar to a lot of the other ones out there. I just like this one because they're growing really nicely and the valuation is very cheap. So at the very least, I think either they get bought out by another company like a PayPal or a Block, um, or they just keep growing. I mean, you have SoFi, you have what's it, Plaid. There's like a bunch of companies that do payment processing, but this one just looks like a solid investment right now. So Shift4 Payments, ticker 4. Let's look at their numbers. Revenue growth, beautiful, right? 1.3 billion a couple years ago, now up to 3.6 billion. Keep in mind, this is a pretty small company, only $6.5 billion. Net income, the chart is a little bit more all over the place, but generally it's heading in the right direction. And the last, couple quarters, they've been maintaining that over $200 million of net income for the year. So that's good. Free cash flow also looking pretty solid at about $500 million. And then the cash to debt ratio is not great. Just this past quarter, it kind of they evened out at about 3 billion, so it's not great. I'd rather the cash be, at least 20%, 25% higher, but that's okay. Shares outstanding, again, nothing crazy. I'm not worried about it, but it's not good. I wouldn't call it good. So it is what it is. Then let's take a look at valuation, right? 12 times forward earnings right now. On this chart, what is this? On this chart, we have this is for trailing PE. A couple years ago, it was trading in the 60s, and then it's pretty much been around a 40, 45 for the last, 2 years, and now we're down to a 34. And again, that's trailing earnings. So the forward earnings is 12, which is a lot cheaper. You go to Yahoo Finance, we're at about a 34, and then forward PE of 11, this one says. So either way, I look at that like the lower, it lowers the risk when the valuation is trading like that. Now, if the company is dying and their net income is trending down and down every quarter, that's a different story. There's a reason it's cheap. I wouldn't want to be a part of a dying company like that, right? This is not a dying company though, because their sales keeps growing and growing and growing, right? And their net income, if you look at it on an annual basis, it is getting better, right? They lost money up until 2022, and now they're doing over $200 million a year. So I like that. Then let's go back to analysis. We're looking, this is beautiful. This is what makes me pretty bullish on this company. $3.89 of EPS last year. Then we have 5.2 expected this year. That's a huge jump. Then 6.5 expected the following year. That's another huge jump. So let's say this company should be trading at like 20, I would say between 20 and 30 times earnings. So we could just be super conservative. Under 20, I would say that's pretty cheap. I don't think it deserves to stay under 20 times. So let's just pick 20. That's a fair number. Especially for a company that's growing 25 to 30%, this stock could be trading at like 30 times or 35 times earnings. But let's just go 20 to start. This year's earnings is 5.2. That means the stock should be $104 as a conservative estimate. That's very conservative. For this company's growth, this stock could easily be 25, 30 times earnings. So 25 times this year's earnings, the stock's $130, right? And then 30 times is when you're starting to get a little bit aggressive with it. But if it was to trade up to that, we're looking at $156 stock, okay? Then you look into 2020. I mean, that's for 2025. 2026, let's say we take 25 times their next year's expected earnings. We're looking at $164, right? And that's only in a year from now. And that's not that aggressive of an assumption. That's a pretty conservative estimate. 27% revenue growth this year. That's big. They're going from $3.3 billion to 4.2 to 5.2. That's very solid. So I like those numbers, and that's kind of why I'm taking a chance. I mean, you look, I just ran the numbers on EPS and PE ratio, and you pair that with the fact that it's trading at 11 or 12 times this upcoming year's earnings, like that's a solid investment thesis right there. So I like this stock a lot. And let me know your guys' well, wait a second. We have more stocks to go. That's stock number one. Let's go to PayPal next, right? PayPal's number two. This is one I've owned over the years and it hasn't gone anywhere, right? And that's what makes me kind of bullish right now is the stock has been at this price for over 3 years now. Okay. So they own PayPal and Venmo, two of the largest finance or payment apps in the entire world. Okay. I think they have at least a couple 100 million users. They have like 300 million users or something crazy. Okay. Everybody uses these apps, but the stock has not gone anywhere. So you would think, oh, well, maybe their earnings is down. It's dying. The growth is gone. Um, the stock hasn't done anything in 3 years. Well, not that this is a super fast growing company, because at this point, when you're that big, the only way to grow is by acquiring other companies. But the charts are solid. Let's look at the revenue charts here. It's slowly inching along, right? So 4 years ago we did 25 billion in revenue. Now we're at 33 billion. So it's not a fast growing company. What are they only growing at? Yeah, we're looking at 5 to 10% maybe 5 to 10%. So we have that. Then we have net income. Net income looks pretty good. $5 billion net income. I mean, the main thing here, again, I just really look at like, is the stock reflecting what the numbers are doing? The numbers are going up over the last 4 years or so, and the stock price is the same. So sure, can the stock just keep sitting at this at $70 a share while their net income and revenue goes up? It's possible. It's just unlikely, in my opinion. Now, another thing to notice is transactions per active account. So it looked like this peak in 2024. And I mean, by then, there was already a lot of other payment companies, whether you're talking about Apple Pay or Cash App or SoFi, there's all these other apps. But that would be, I would attribute that to why their transactions per active account is going down. So that's something to take into consideration. But again, this is PayPal's they're like the number one company for payment processing. I read they got the deal with to be integrated with ChatGPT. That's a good sign. And I see this as low risk. They're buying back shares. Like, I mean, I'm not expecting to like make a fortune off this stock, but I mean, I think I can make at least 30%, 40%, right, over the next 6 months to a year. And that's with basically, I look at it like almost no downside, right? I mean, what am I going to go down 5 or 10% maybe? I don't see a lot of downside in this. So let's see, what do analysts have them doing for their EPS here? 4.6, 5.3, 5.8. Okay. So, I mean, I think this stock should be like $100 or something. They're only growing 5 or 6%, but this stock could be I think this stock should be $100 to be honest. That's my thesis. But again, the great thing about investing in something like this is I don't see this stock going down too much. I don't see it going to 50 or 40 or $50. I see it staying in the 60s maybe for a little bit, but honestly, I think a fair valuation would be like 100. So that's pick number two. Then we're going to go to Meta. Meta is, this has been one of my favorite stocks over the past decade, really. I think it's one of the best companies to invest in. I've made so much, I've done so many trades with this stock just because there's been so many buying opportunities. And, I've never said, oh, I wish I didn't buy it or I bought too much. I've only said I should have bought more Meta stock. I've only said that for the last 10 years. And again, this company's like PayPal. They own two of the biggest platforms, Facebook and Instagram, and that's a very strong moat to have. They have everybody's attention, and I like Mark Zuckerberg. They just have a lot of things going for them. So this stock is down a decent amount. We're looking at it topped out at 785. Now we're down to 610. I do think it could go lower. I think the stock could go to in the 500s if we do have a little bit of a correction in the market. I could see it coming down to 550 or 530 or something, but I'm okay with making a little position now. And then if that happens, then I will buy more shares. But when you look at the valuation, it's still, even if we do have a correction, this valuation is still cheap. Okay, I think forward PE on this is 21 right now. Normally it's like a 25. So 4P of 21, normally it's 25, 30 even. So I'm fine with buying this at 21. If it goes down to a 16 or a 17 or something next year, okay, great. Then I'll buy more. This is not a stock that I'm really concerned with. And I'm happy to be a buyer of this. If we look at I mean, we don't even need to look at this company's numbers because we know they just keep getting bigger. But I mean, $189 billion of revenue this year. Net income took a little bit of a fall there, right? It looks small, but really we're talking that's what, $12 billion there. So, I mean, again, I'm not really concerned though. I think it's going to go back up to $70 billion, let's say. They keep growing daily active people. They have 3.5 billion people on the platform. That's practically half the planet. And I don't know. I'm not worried about this one. It's not, this is not some like risky stock to me. I just see this as solid investment. So Meta's pick number three. My fourth one is going to be Pinterest. I just bought this a couple of weeks ago, and I'm not even really a Pinterest user. I've been on there a couple times over the last couple of years, but again, let's look at the company's numbers here. I mean, even if I'm not, I mean, I saw in their earnings report they have over 600 million users. Like that's a lot. That's a ton. Again, though, this is most of my thesis for investing is a cheap valuation. I'm paying a fair price. 14 times earnings is cheap. I mean, when I see that, I'm thinking, oh, this company must be growing at like 2% per year, right? But what is this company actually doing? They're growing at what, 17%, right, over the last couple of years. This net income chart sure is weird, right? How it just jumped like this, but they've done it now for over a year now, right? Over a year, they've had this net income of nearly $2 billion. Free cash flow is beautiful, right? So the cash flow in and out of the company is great right now, over $1 billion of free cash flow. The cash to debt ratio, beautiful. 2.6 billion in cash, only 200 million in debt. I like that. And then let's go see expected EPS and what the growth is for Pinterest. Again, 14 times earnings. That makes me think that they're not even really growing. So forward PE of 13, okay, I'm paying way cheaper than what it's been the last year or two, right? So I like that. Analysts have Pinterest doing 1.2 to 1.7 and then 2. I mean, think about that. Next year they're doing, if they do $2 EPS, that means this is going to be what? Trading at, yeah, I mean, let's see. What is that? 11 or 12? 13. Okay, 13. So 13 times earnings, the company's growing 15 and 16%. Like the P ratio should be like 25 on this, you know? 25 times 250. So I mean, I think I could double my money on this. I don't I think that's very realistic. So, and again, look at how the stock is. The stock's in the 20s. The stock was in the 20s from 2022 on. So we're going to go on year 4 now of the stock being in the 20s when their net income at that time was negative. Like they were barely making money or losing money. Now they're doing over $2 billion. Like the stock should be back up here to 50 or 60. So I might even buy more of this because this one just looks like, here, let's buy a little bit more. This one just looks like easy money. Let's put in let's go 10 shares for right now. It just looks like easy money. So those are my 4 stock picks for this month. Let me know what you guys think, and I will see you in the next video.